We are now live. Welcome back, my passive income investors. We're back again, like last Wednesday with Matt Money, to hopefully answer some questions, have some fun, and hopefully get some of y'all on our live stream, guys. We want to have some conversations. Myself and Matt were just discussing our six-figure portfolios as we were putting together some more courses and some extra talking topics for passiveincomeeducator.com. And I'm glad that we have some people slowly trickling in here. But I'll let Matt kick it off. If you got anything you want to say, you want to talk about earnings, the Disney.
No, man. I've actually been able to listen now that I'm working from home. Be able to listen to earnings calls like live and in action rather than having to wait till like I get home at night to be able to kind of catch up. And so it's been pleasant to kind of listen to the earnings calls while I'm actually working. I have been able to do that in the past, but somebody will stop by my desk or something like that. So it's nice to be able to listen to a coherent, long earnings report, listen to the CEO, the CFO, kind of talking back and forth and seeing where they're coming from. So it's been a nice change, been able to kind of like listen to earnings calls back to back. Like you and I both listened to the Realty Income yesterday and then Disney right after, and you even had one before Realty Income as well. So it's been nice being able to listen to all of them for sure. So that's where I'm coming from.
Any favorites?
I personally, I didn't get to listen to all of Disney's. So I did get to listen to a lot of the Q&A though. And I personally think that Disney's is going well. I know how you feel potentially about it, but I think that Disney's a good one to purchase right now.
Did Matt cut out? And
I can expand on that.
Give me a thumbs up if y'all can hear me. I think we just lost Matt, but I don't know if we just lost Matt or if we just lost me. Are you back?
I can see you. Yeah.
Could you hear me all right?
Yeah.
Yeah, I don't know if my internet's just starting to get a little flonky on me here. If we cut out again, you guys will know why. I've been having a lot of issues with my laptop, and I was just joking with Matt that there's a chance that this is going to cut out, and if it does, you'll know why. So I lost you there. I thought the whole thing froze, but I think I was still moving. If you guys want to let us know if it's getting too choppy, just let me know in the comment section, and I'll try and switch over to my LTE here if I can. But yeah, so you were saying I missed you out on Disney there when you cut off.
I was just saying, I think it's a relatively good quarter. I didn't think that they did too bad, but I think there's probably going to be worse earnings to come in Q3 for them because I think they report things a little bit different than some other companies. So this was actually their Q2 earnings, not their Q1. And so I think that their Q3 earnings will be interesting, but I think overall it's a good time to potentially buy in if you don't have a position. I'm going to be waiting for them to kind of dip back into the 90s personally, if I were to take more of a position. And even though they cut the dividend for this particular payment, I think that they have a lot of growth opportunity in the future. I know some people are very polarized about it. Some people think Disney's kind of on their last leg, and I think the best is yet to come. So.
Yeah, I know you sent me their earnings report, and I skimmed through it. Like they have a lot of growth coming out of some of their other sectors, which isn't too bad. But I think they were still heavily reliant on parks. I mean, what can you say, right? I think it makes up for what 30% of their revenue, or something like that.
I don't remember exactly, but it's pretty significant.
Yeah, it's a pretty large chunk. Out of all my earnings, man, there wasn't anything crazy huge highlights. I think I was just discussing with you. Maybe we'll have this moral debate with the guys in the comment section here. We were discussing about dividends and if a company like Apple should have the right to donate as much as they do to charities instead of giving it to shareholders and letting those shareholders, if they want to donate it to a charity or use it for their community, whether that's the morally right option to do. As I've noticed, Kevin O'Leary brought it up a couple times. And I mean, I only just captured like some of the bigger earnings. I mean, most of my individual stocks and my REITs, they weren't that exciting because we're all kind of on damage control right now. Whereas those big tech giants like Apple, they don't seem to care as much about, what the future looks like because they'll be fine. They know they'll be fine. So they're more worried about getting us through the short-term issues, helping the people that need help. But that does bring up that interesting debate because I know you were saying that you get these companies that are so highly dividend focused that they pay out as much as they can. And then a situation like this arises and they don't want to cut their dividends. So what they do is they take out debt, which also isn't that beneficial for you as a shareholder. It'd probably be better, like I've said, if they just cut the dividend outright and then let it come back when the economy opens up, because that way you're not left with this overhang of debt that you have to come back to pay sooner or later as those chickens come to roost, as I like to say way too much. But yeah, man, it's I'd love to get your take on that aspect of things and what you guys in the comment section here below think as well when it comes to what these companies do with their money.
Well, I think I've noticed a very different trend nowadays. So I listen to a lot of Simon Sinek. So I don't know if a lot of people in the audience will have listened to this, whether they're in the chat group now or whether they will be kind of listening back as this kind of plays as we kind of have it recorded. But Simon Sinek is a business consultant. He talks a lot about finding your purpose and your why and as to why you're going to do things. And I've noticed a lot of companies transition from strictly purely about profits and strictly about what's in the bottom line to more purpose-led organizations. So think like your Costco's, your Amazon's, your Tesla's, your Apple's to an extent. And it's almost as if your purpose-led organizations, while may or may not necessarily lead to profit in the beginning, throughout the long term, if you're leading your purpose and you're leading the organization down a path of righteousness, and whether it's leading what people are looking for rather than strictly looking at the bottom line, profits soon outweigh what you would have expected, because you're not essentially pinching pennies to make sure that everything's going in the right direction. And so you saw that a lot with Apple. Apple didn't necessarily care all too much with respect to what shareholders wanted. They kind of did what they wanted. Same with Tesla. Costco, some people were like, hey, you guys are making a crap ton of money. Why don't you give some more to the shareholders?
Continue.
At the same time, they're like, you know what, we're going to treat our employees better than the way they should be compared to everyone else, because of just the way that we should be operating, right? I mean, if you treat your employees well, that'll then drive down the cost of continuing to retain people and the acquisition costs associated with getting more employees. And so it's a little bit less about, yes, it's taking more of a long-term view of the organization rather than strictly always talking about profits and specifically dollars and cents today. And so I think when they're talking a little bit more about doing these charitable donations and things along those lines, it kind of fits in line with that sort of strategy. You're able to specifically be more of a brand that cares and has a purpose led around it, rather than strictly being about the numbers. And so I can see both sides. Of course, as a dividend investor, I would love to get my continued dividend growth and my money back into my pocket. But at the same time, I think that if a company was only strictly about dollars and cents, it might not necessarily come off the right way, and it might actually destroy the brand. And I think listening to Realty Income Corp's earnings call yesterday, I think that I heard a lot about that compassion and that a lot of that purpose-led sort of organization kind of mantra starting to come in, rather than strictly the dollars and cents.
There's been a lot of frustration as well, though, being shared. They've been pretty professional. Sorry, I dropped my cards back here. I'm gonna pull them back over, because you'll notice I put them there because my camera focus. You can really see it now, like when I got this blinding ghost light. But yeah, no, I totally agree. I think there's a big image purpose behind it as well. And when you're buying into these stocks, especially like Apple and stuff, I think they have to some extent, maybe a right to keep up that image. Maybe if I put this behind my chair, it'll enclose me in a way that you guys can see me a little better. I don't know. I might end up deleting this stream. So if you guys have got any really good questions you want to ask, now is the time, because a lot of people might not end up seeing it. There we go. We're back. But yeah, no, man, I'm going to lean on this and we'll see if it helps out any, but I totally agree. I noticed on those earnings calls, especially with the REITs, like Realty Income, like they've been getting the hard ass side of them is starting to show. Just because they have people skipping tenants or skipping rents, tenants skipping rents. And it's, and some of them are doing it purely because they think they can get away with it and they want to do it. I mean, RioCan, I keep comparing the two because the similarities to me just blow my mind on both sides of the border. Because RioCan is running into the exact same issues. They have a certain percentage asking for deferrals, but then they have people outright just not paying their rent. And they're just saying, well, look, we're just going to wait till this comes back. And they're not negotiating. And I've noticed now we're starting to see these CEOs tighten up a little bit, and they're starting to get a little pissed off with that. But I think overall the REITs are going to be doing just fine. So long as we come out on the other side of this, okay. But we got to excuse me. Do you think Realty Income's monthly dividend is here for the long term? Only if they don't see any more tenant deferrals. RioCan and Realty Income have the same exact problem right now. Is their payout ratios are fairly starting to squeeze closer and closer to that line, where if it inches much farther, they're either going to be left with two options: pay the dividend with debt or cut the dividend. Honestly, if I'm a gambling man, I don't think they're going to cut it. I don't think that the economy is going to get that bad. I think we're going to start coming out on the other side of this after the next 2 or 3 months. So once we get through this quarter, this will be the last real quarter of hell. And then I'm going to presume that society and life hopefully starts going back to somewhat of a normality. I'll let Matt touch base on that as well.
No, I think, I'm going to personally say, and I said this before, and somebody bashed me the other day. I was just like, it's too early to tell. And I think somebody asked me that like last month about stocks just in general. They're like, well, what do you think about stock market? Do you think it's going to go up, go down? Do you think we're going to get worse from here? And I'm like, it's too early to tell. And this was like in mid-April, I think. And somebody completely like scolded me and was like, how is it too early? So I think once we start actually seeing the reopening of the economy over the next week or two, I'd say by middle of this month, we'll actually be able to really see how quickly things are kind of going back to work. You have companies like GM, they're going to start restarting factories on the 18th of May. You have restaurants that are still starting to kind of get back to work. You have theaters that are starting to open back up as well. And so I think that until you kind of see how May plays out, it's difficult to answer that question. I'm an optimist, so I'm going to say exactly what you said, Kyle. I think that, if this plays out for the next 2-3 months, I think we'll be okay. And exactly what the CEO and CFO said in the call yesterday for Realty Income Corp, if it's a 6-month to 12-month problem, it's going to be a different conversation. Okay. They didn't have this sort of issues that they saw today in even the great financial crisis 12 years ago. If you kind of go back and look at those, they didn't have nearly as many problems. This is way more severe in terms of for real estate, specifically retail real estate, than that was. So.
Yeah, it's going to be neat to see the damage left over. There's still a lot of risk associated with it, but I think I want to have some fun. We got about 26 people in here right now, guys. We just wanted to hop on for a real quick live stream just to have some fun. We're bored hanging out, corn streaming. So I might even end up deleting this. I just wanted to hop on for fun. So what I would like you guys to do is ask us some of your hard-hitting questions. We got a ton coming in here. So I almost want to do like a Jim Cramer lightning round here where we'll just hammer through them. So we'll start with Matt. What do you think of BA? I know this is one that you know more about than I do, so I'll let you answer.
I'm a buyer. I personally think that BA is a good long-term hold. What does concern me is the about $25 billion that they just got on the bond market. And so I was just doing a quick look. I think they acquired bonds anywhere between 4.5% to like 5.5%. And so then if you do 4.5% to 5.5% off 25 billion, it's another like $1.2 billion in interest they're going to have to pay every year. And so until they start paying off some of that debt, maybe they're able to return some of that. Maybe they don't need all of it, especially if the economy kind of goes back to work in the short term. But if they end up utilizing all 25 billion of that just because they need near-term liquidity, then that's going to be a pretty big strain on the cash flow statement in the upcoming years. And so I would just be cautious of that. But I think from here, just based off of the asset value of the organization, I think it's a decent buy. I think in the short term to medium term, it'll kind of at least go to the high 100s. So probably $50 or so increase per share from what we're seeing now. But you're seeing ranges from analysts anywhere between the 90s all the way to back up to 300 in the next 12 months. So really curious. I don't think 300 is where we're going to be in 12 months by any means, but I definitely think it'll be way higher than $125 that we closed at today. So
yeah, I think this leads into the next question we got here as well. But I'll touch base. My opinion on the airlines, I wouldn't take literally because I don't know enough about them. I don't invest in them. The only thing I could say about them is similar to what Warren Buffett says. You got to be really concerned about the debt loads they're taking on, how long. is it going to take for them to pay back? And we don't even know how long they take to pay back because we don't know what the new economy, when it opens up, what it's going to look like and how fast it takes to get that economic machine running, especially with people traveling back to the way they were. So that's one of the big fears. And then the second biggest fear is definitely the competition. I noticed Buffett touched base on something a lot of people didn't mention, which was that he's got some concerns about the fact that there's so many plane companies and there's so many new planes that are constantly being pushed into the system that it's starting to saturate the competition, and it's causing lower and lower prices amongst obviously all the different airline companies, again lowering the their margins. But it's an interesting take. So I'm going to ask you then, what are your thoughts on Berkshire? Good. You own some BRKB, don't you?
I have in the past, but I do not own any at the moment. I think that Berkshire Hathaway is a phenomenal company. I have analyzed a lot of their individual companies that they own. So like things like Berkshire Hathaway Energy, which is big into solar. And actually, I think it might be one of the biggest solar plays in the United States right now. So if you are interested in that, it's worth a look. But I think they just have phenomenal conglomerate of organizations that are really underneath the umbrella.
Yeah.
And I think that if anybody's interested in having one big diversified play, I think Berkshire Hathaway is a good opportunity. I'm pretty upset the fact that I tried buying a partial share of Berkshire Hathaway A-class shares, and I was unable to do that.
On what,
I was just
M1?
like, you can buy any fractional shares nowadays. Let me give it a try. And Fidelity yelled at me. They said they do not offer fractional shares.
Fidelity.
And I was like,
can you
I
do
thought
that
this
through
was America.
Can you do it through M1 Finance? Will they actually let you fractionally buy
I'll try. I'll give it a try.
I've never heard of anyone doing it, actually. It's a good question. I imagine they'll do it with the B shares for sure, but it'd be hilarious.
B shares for sure. A shares, I thought that I would be able to, but I was unable to do it.
Yeah, I'm on the fence with the Berkshire Hathaway holdings. Honestly, I would never buy it. I would rather buy the components themselves, but I don't know. There's the big debate right now whether Buffett's going to outperform the markets or not. I think this is the first time he's starting to underperform the S&P 500 in like 20 odd years or something. But that's a good question, man. Berkshire has been fun to watch lately with the whole airline topic going on, which led me into a question I just forgot about that somebody asked up here.
But I think going back to that, I think it all depends on the investor, right? So I think if you're looking for high growth, you're not going to invest in Berkshire Hathaway. If you're looking for capital preservation, that's something that you might look at. You have to think that Berkshire is a cash flow machine, right? So it's not necessarily looking for massive growth anymore, right? I mean, I think that what they're looking for is slow and steady sort of growth that can be depended on for years to come with a low beta. I don't think that they're looking for the large sorts of outrageous returns, and nor do I think they can just by getting the cash flow that they can. You think about it on a year-to-year basis, they might grow cash by 20 odd billion, 20 to 30 billion dollars. And what kind of deals can you get every single year to invest 20 to 30 billion dollars that you can automatically get like a 10 to 15% return every single year? I mean, that's what you'd be looking for, right? You'd be looking for the opportunity to invest 20 to 30 billion dollars a year to be able to return anywhere between $4 to $6 billion in cash on the balance sheet that would be able to be returned, back to the company, and that's when you would start outrunning the markets. But unfortunately, how easy is it to find 20, $30 billion companies every year?
Yeah, the size is the scale is what starts becoming the issue, right? This is a really good question too that I wanted to bleed into, which is how do you feel about stock buybacks? And I think this is going to become a very interesting debate moving forward. Ever since the airlines ran into the issues we just ran into, because if you want to say buybacks are a good thing, well, clearly in the airline industry it wasn't, because they stretched themselves too far doing share buybacks, and now they almost bankrupt the companies, and they would be bankrupt technically if they didn't get bailouts or at least have some kind of credit facility. So, I mean, you have to keep that in mind, but that's a hard thing to value in a company, right? Like, how do you recognize when a company is doing too much share buybacks and not enough cash and investing going on the back end of the company? Because I mean, if you take something like an Apple, for example, I mean, Apple has so much stupid money that I mean, they could double their share buybacks and they'd still be they're still not going anywhere. So I mean, it's a tough debate. I can actually maybe try and make a video specifically on that topic, because it's something I've never really looked into either. But I mean, it's something many people probably overlook, right? At the end of the year, hey, there's extra capital left over, share buybacks. Let's just throw it in and give it back to shareholders. And then, oh, we've spent all our money. Now it's gone. But I don't know. What's your thoughts on that?
My thing about share buybacks is that it's a good way to reward shareholders, that if you stop or cut or suspend a buyback early, I don't think you're going to get the sort of lash out that you would as if you were to be doing the same with a dividend. And so, yes, you're seeing a lot of companies nowadays cutting buybacks, but those aren't the companies that are being oversold or basically being crucified based off of, a dividend cut, right? So
Yeah.
I think that buybacks are nice because it's discretionary spending, and one, it allows the company to reward shareholders, but at the same time not have to do it for the long term. If you increase a dividend in the United States for $1 billion in one single year, you're gonna have to be paying $1 billion for the next 100 years or forever. Otherwise, you're going to get crucified. If you buy $1 billion worth of stock back for the company, you can then just eliminate that $1 billion. And not only that, but if you're also paying a dividend, you no longer have to pay $1 billion worth of dividend yield, let's say.
I think that's a good...
If it's a 1% dividend yield, now you don't have to pay an extra $10 million. You know what I mean?
I totally agree. I think that's a good topic, actually, or a really good note that you touched based on there. And just too, when you look at historical past in stocks, I mean, that's something else that you're going to actually have to start calculating in, because I mean, share buybacks have only recently, maybe in the last decade, become super popular. And now you literally, if you go look through a company's history, you're probably going to have to try and figure out how many share buybacks they did over that history, and are they still doing it to the same level? Because I mean, if you take a company like Apple, imagine what would happen to Apple stock if they completely cut share buybacks. I mean, it would destroy their EPS. They would actually become a normal company again, other than they would have that cash. But that, you got to remember, when they're pulling those shares off the table as well, it really drives up the earnings per share, because less shares are on the table, the higher the earnings look per share. So I mean, yeah, I think understanding stocks in that aspect is going to become a whole lot more challenging. But maybe we'll throw a few more in here. I don't want to spend too long on this stream. Figure we'll pop on for an hour here, guys. We got 28 of you floating in. You guys are asking some pretty good questions, so I'll throw Matt a few more. So a lot of you guys obviously talking about Disney stock here, so maybe I'll get Matt to chime in on some what we think about them Disney's corporations.
So I held off on it a bit at the beginning of the stream, but I think it's a phenomenal way to look at it. So I'm going to compare Disney and Netflix currently, right? And I think I've been doing this a lot over the past 1 or 2 days. So if you've heard me kind of say it, or I guess maybe it was mostly last night, if you've heard me say this already, whether it's on our Facebook group or our WhatsApp group, I apologize. But Disney and Netflix at the moment are valued at the same market cap, about $180 billion. And if you look at Disney, they're not a streaming company now. They're kind of a conglomerate full of intellectual property, television companies, and parks and cruise lines. And, they're a conglomerate of entertainment, I guess you could say. And more recently, they've kind of gotten to the venture of streaming to kind of compete with Netflix. What I want to specifically focus in on is the streaming aspect of things, or what Disney would call the direct-to-consumer part of the business. And as of last year, 2019, the earnings in the subscriber base of strictly direct-to-consumer products for Disney, I believe, was less than 40 million subscribers, and it was mostly limited to Hulu and potentially Disney Plus, or not Disney Plus, ESPN Plus last year. This year, now they have Disney Plus, ESPN Plus, Hulu. Not only do they have live TV Hulu, but they also have playback Hulu, which are at different price points. So to put it in perspective, Netflix is a $183 billion company with 185 million subscribers. So they're paying about $1 million per subscriber. It's not $1 million, $1,000 per subscriber. Disney, on the other hand, at the end of April, they closed with 55 million Disney Plus users, plus about 30 odd million Hulu users. and about 7 to 8 million ESPN users. If you total that up, it's about 90. So it's about half the amount of Netflix. Yet Disney has only been basically doing Disney Plus, let's say, for the last 8 months or so, and it's already grown from like 40 million users last year to 90 million users in total. Granted, that's spread across not only Disney Plus but also Hulu and things along those lines. So if you think about it, Disney is a massive growth company in the streaming space at this moment with massive intellectual property. And in my opinion, what I would view Disney as almost is the potential to be the world's greatest television/streaming company, basically competing against Netflix. And the way I say that is they have everything from American Broadcasting Company, ABC, they have ESPN, they have a sports network. Netflix does not have a sports network. And they have Marvel, Star Wars, and so the intellectual property, and now Fox as well. So they have Spider-Man, they have Fantastic Four. They have
I don't even think you could write a list if we're being honest.
Yeah, so I mean, pick all the Pixar movies, Toy Story. I mean, you think about the intellectual property that Disney has. As soon as those licenses are up with Netflix, a lot of the entertainment that you're going to see on Netflix is going away, and so you'll see the same happen with all organizations. But I think that now that Disney, one, has the best intellectual property, and two, is currently the second biggest streaming platform, maybe aside from YouTube, if you consider that a streaming platform as well, comparing it to, say, Netflix and YouTube, then, I mean, I think it's the potential for growth in it is phenomenal. And then if you look at the other businesses, the normal movie business, normal television broadcasting business, and the ships and in the parks, I think that it's a phenomenal company to own, especially under $100, specifically for the future. And that's, in all honesty, that's why the stock jumped from $100 to $150 a share over the past 6 months or so.
I think where it sits right now, it's at a good, if you're looking for value territory and you're not too concerned about the dividend, comparing it to Netflix is a challenge. I haven't looked at their recent earnings, but I always had a big problem with the company because they're constantly trying to keep up on the entertainment. And I mean, all their money gets bled out into new shows. So, I mean, Disney might even have the benefit over them on that. The fact that they have so much content already, and the fact that it's content that people rewatch over and over again. And I mean, Netflix has that with some of their shows like The Office, but to what extent is the new material they're making like rewatched time and time again, right?
But to go back to what you just said, The Office is not a Netflix product.
No,
so if they lose the license for The Office, just like they lost the license for How I Met Your Mother or any of those other, they go away. And Netflix will lose some of its content that some people have been watching for years and have been kind of keeping Netflix afloat. And some of the Netflix content is good. I'm not going to lie. I love Narcos. I love Ozark. I think those are phenomenal shows, and I watch them, and I will continue to watch them. But do they have the lasting power or like the, I guess, intellectual property of like a Marvel or a Star Wars or a Pixar? And I don't think they do.
True. It's weird how they're valued when you compare them back to back. I've never really been a big fan of Netflix as a stock, but I haven't looked at the earnings recently. I don't know what's changed. I just can't imagine things have gotten that much better. Independent investors, a big fan of Ozark. I managed to catch the season. I'm kind of on and off with it. I like it. I don't like it. It kind of reminds me of Breaking Bad. I got into the Tiger King for a little while. That was kind of interesting, but that also isn't. Or that wasn't. Was that Tiger King wasn't Netflix? Was it?
That was. Yeah.
Was it Netflix? Oh man, they smashed it out of the water with buying that one. I can't even remember where I watched it. I don't know if I watched on Netflix or something else. The box maybe. I don't know. But yeah, on the Netflix side of things, I'm not really the biggest fan overall, but I would definitely say Disney's at a decent value here, so long as you're not looking for dividends. I mean, Disney, you're gonna have to wait for Disney to come back to get any real dividends out of them. But to shift topics a little bit here, maybe we'll touch base on a few more and then fly off. Thanks, Captain Ryan, for popping in. If you're still floating around, we're just messing around right now, just trying to have a little bit of fun, taking some questions and answers today, guys. But let's shift focus from the conglomerate that is Disney in the spotlight to the casino stocks. Maybe we can talk about some Wynn, some MGM. What are your thoughts, Matt? Have you?
I'll leave that one to you. I personally don't have much due diligence done on those companies, so I don't want to talk about a stock I don't know about.
I've itched on Wynn Resorts a lot. I honestly think they're. It's a tough debate, man. It's the same thing with Disney right now. Like they're great, world-renowned companies. You just got to sit on your hands and survive through this, and then just give it a year for everything to normalize again. So I mean, I loved the casino resorts. What stopped me from buying them was when MGM decided that they actually wanted to sell off some of their biggest pieces of real estate when they were trying to sell, I believe, the Bellagio and the MGM, the main resort. And I couldn't figure out why the company wanted to liquidate those parts of their portfolio. And it made me terrified to buy into it. And the other big problem, too, with these casino stocks is they've had a hell of a time trying to find extra ways to produce revenue. I mean, people keep forgetting there was a time in Las Vegas where limos were free, drinks were free. A lot of things were luxuries you got from being in the casinos. Now you pay for Wi-Fi, you pay for any driving. They pay to make you park now. Parking used to be free. Like they're doing everything they can to try and make to get those earnings come up, man. Like if it wasn't for these little things they keep itching into their balance sheet, I mean, they'd have no growth. It would be nominal at this point. So I mean, that's why I think you'd rather go with something like a Wynn Resorts, because I mean, Wynn hits those luxurious, like they're hitting the premium of the creme de la creme of people with money, and those people are spending that money at those resorts. So I mean, like they have like they're hitting the top tier class that you'd want to hit if you're buying Las Vegas companies. I've dipped my toes in and around them a lot. I just never pulled the plug on buying any. I kind of wish I picked up Wynn when it bottomed out, but I didn't have any cash. I was kind of poor in March when things were getting real tight for everybody. So I mean, I don't know what else I can say about the Vegas industry, but I like it, man. There's nothing better than gambling. I mean, go look at Carnival Cruise. Look at that balance sheet until, I mean, they're just as corrupt as Vegas is, right? Like they don't pay taxes. They got casinos on there. They're raking in dough without paying a dime on. So and they were doing great. Their business model is almost the exact same as Vegas, other than they don't pay tax. And now look at what happened to them, right? Like they're all in the same boat. Get it? What's Independent saying here? He's throwing something up. We got Wynn would have been a great entry at 35. Yeah, I know. I totally agree, man. When it dipped way too hard, too fast. And that was the same with everything, right? Like it was just having capital, though. I mean, how many people put your hand up if you were able to catch that dip? I mean, I didn't personally catch it, but I managed to catch it for my girlfriend, a little bit for my mom because they had money. My funds dried right up, and I mean, the stock market didn't give enough of an opportunity, long enough opportunity for people to actually get in. So I mean,
I was hoping for at least like 2 weeks to a month where it would kind of bottom out and then kind of return back up. I didn't expect it to literally be a matter of a day or 2 days where it would kind of hit this bottom and then immediately shoot back up. I mean, it's difficult to deploy capital that quickly, and with a significant amount of power, where you'd be able to actually fully utilize that sort of dip.
And balls too, man, because I did buy when the dip started. I mean, I was buying stocks. I think one that I can throw off the top of my mind was RioCan, which I was buying from the 25 area. When it dropped down to $19, I bought a bunch more, and then it dropped down to $12, and now it's hovering between the $14 and $16 range. But I mean, like, that's the other thing. It's fun to look back and be like, oh, well, did you buy the bottom? It's like, we didn't really know what the bottom was, but I mean, there was a real good vibe when stocks started hitting those insanely low levels where I started flipping out. Because I think it was a day or two after things got insane that I bought my girlfriend a ton of Facebook stock, which she's thanking me for right now, obviously.
And I do agree with what Ryan was just said. Actually, it was kind of like a super flash crash. He's 100% right. I mean, if you look at the monthly charts, it doesn't even show the 52-week lows of some of those organizations. I mean, if you look at like Realty Income Corp or something, for example, if you look at that day, it might show 41 or 42 bucks, but at its worst, it was down to like 36 or 38 bucks that day. And it was like, what? You know what I mean? Yeah. Like I remember just that span of like 2 to 3 days, I saw Realty Income drop from 50 down to 48, and I said, yep. And I bought my first tranche, and then later that afternoon it was down to 41.50, and I was like, yes, please, next tranche. And
Yeah, you unloaded a lot of capital though too, right?
I
I mean,
did. Yeah. I mean,
you definitely,
I did have a lot sitting on the sidelines. I just got paid a bonus as well. So fortunate for that. It's not like I had new capital into, I guess, what you consider the portfolio, because a lot of it was already sitting kind of on the sidelines, because I do have that personal savings that I kind of utilize. But so normally what I'll do is I'll move a decent amount to the personal savings, and as soon as I want to deploy it, that's when I'll move it over into the brokerage account. But
yeah, you kind of strung yourself as dry as everybody did. I mean, you luckily you loaded in there because I think you picked up some Vanguard index too at an incredible price, didn't you? I think you got VOO in there too, didn't you? At a good price. I remember you texting in the chat group. I could be wrong.
Well, okay. So yes, in my 401k also, yeah, I did purchase at a decent price. So I did. Luckily, I had a decent amount of cash in my 401k that I did miss out. I'd say on about 6 months to a year of potential growth over the past year or so, just because that was sitting in cash in my 401k, because I was potentially going to do some movements into different accounts with that. But as we did start dipping down, I did start deploying that capital in pretty systematic way. Every time it hit a new low, whether it was 15% is kind of when I started buying 25%, then 35%, 45%. But I never got down to the lows at about 50 to 55 to 60, where I was supposed to deploy the remaining capital. So
Yeah, I've been strung hungry for cash right now, but I got pretty lucky there though. I mean, I still have some capital laying around. I'm trying to keep as my little bit of an emergency fund, a little more than I had before, and I've been debating on throwing it in the markets right now, at least some of it. But I'm just waiting and watching, man. I'm really debating on whether I want to still utilize that line of credit. I've kind of come to the decision now that like I have no problem using it for the stocks that I want to buy with it. I'm just waiting until we get closer to the next dividend X date, and I might throw 2 to 3,000 off the line of credit to start. I would need to scale it to about a 7K position though for it to be worth the time using the credit. But at this point, I feel pretty comfortable. I listened to all those earnings calls, and that's pretty much all I'm left with, other than trying to stir up work here at home. I mean, we've done pretty well with some of the other income sources we had, but I guess that's most people's problems. If you don't have a job right now, you're probably not buying too many stocks. But I thought this was funny. I haven't read this full thing yet here, but I thought this was interesting. Why don't you guys consider running a joint live stream more regularly on Saturdays? I think you guys could do really well. If you're still sitting in the stream here, Ryan, I was actually going to ask you this on Friday. I was going to hop into your live stream a little bit earlier because myself and Matt are with our the website that we started, the Passive Income Educator. We wanted to basically launch a new YouTube channel where it'll be more community based and more live stream based, where basically we would get together every Sunday and we just talk stocks. And then we would try and get you to come on. We would try and get JMac and just constantly have a regular discussion going on and try and find a way to share the YouTube channel amongst all of us and try and do maybe like a shared plan or something, and try and build the YouTube channel up. I was going to share it in this stream to try and start building up the subscribers on it, because I know we can't do StreamYard live streams without getting it up to 1,000 subs. But I think we're thinking about going down that route, because like days like this where I'm bored and Matt's got just hanging out, we like to just pop on and do questions and answers. But it would be fun to make that like a regular Sunday thing. So I mean that was one of the ideas we've been floating on as well. So you guys can let us know if that's that would interest you. I wish I could share the link. The old YouTube channel was called Passive Income for Dummies, and then I just changed it to Passive Income Educator. But as I progressively make videos for the rest of the week, I'll probably bring it up again. But I think it would be an incredible place for everyone to have a nice Sunday place to go. No one's really doing Sunday live streams, so I think that would be fun for us. Yeah, we got some people thinking it's a good idea too. Maybe what I'll try and do is maybe if I can hop open the link right now and I don't lose this, I'll show you guys the YouTube link if you want to subscribe while we edit everything together. Just give me 1 sec here, guys, and hopefully I don't lose the stream. If you got anything you want to add, Matt, you're welcome to while I lag.
Well, I mean, so I love when you kind of bring up the topic of kind of relying on a line of credit to get that extra capital influx. But I think it's kind of interesting because you kind of utilize that as kind of a kind of way to inject extra capital into the markets. But I think if you were to view your personal life as sort of a business, you're kind of a lot like some of these organizations that are kind of going on right now, whether it's Realty Income or Disney for that matter, where you're kind of losing business. And so the thought is like you're going to go to the markets to essentially get that additional liquidity into the portfolio that you can then utilize to, I guess, either invest further capital, but at the same time, that's also going to potentially impact your short-term cash flow. So it is kind of an interesting conversation as to whether or not that is something that would be wise to do, or if it's something that you should hold off on. I'm would be curious what people in the comment section believe. I personally think if you believe enough in the markets, then it's a good idea. But at the same time, it does seem like it is somewhat of a risky play, because then you might end up having the same sort of situation where you might have to sell it because you are in a cash crunch.
That's the scary thing, right? Because I'm lucky enough to be in a similar situation to you, where the cash flows really help out. I mean, I'm fairly comfortable that if I had to tap into those dividends, I mean, I'll make 500 or 600 a month that I can spend. But somebody that's newer to investing, that might be getting more cash struck, that just started building their portfolio, they won't have that luxury, right? Like you're saying, they might have to liquidate some of their positions and use that to live on. It's definitely interesting times, but I wish, because I'm trying to speak to somebody that's more in my situation, but it's very hard because it's so circumstantial, because I've been fortunate enough to have diversified streams of income that, yeah, I lost my largest stream of income, but I'm still likely, even if that work doesn't pan out, because I just lost all my June jobs anyways, and everyone's trying to reschedule for fall. So we can just presume that almost my entire year's worth of full-time income is completely written off. But the same notion, because I've had so much time to work on other stuff, I'm still likely to make somewhere between $20,000 and $30,000 just off everything else I'm doing, between YouTube, the websites, selling stuff around the house. So I mean, and I'm lucky enough to be in a frugal situation where I don't have to throw all of that toward bills. I mean, I'm still operating, even at the minimal income I have, in a situation where I have money left over at the end of the month to invest. But I also am starting to get a little on edge about not pushing myself. That is what I definitely learned about this crash, was that I'm too cash stricken. Like, I just don't have enough of it, because I've spent so much of my mentality focused on cash flow, which worked out. I mean, I actually, it technically worked out, because I spent the last 5 years building up my cash flows to the point where if I lose my job, I still have something coming in. So, I mean, in that aspect, it worked. But in the other aspect of, trying to get by today, I mean, I drained my accounts to zero by the end of March. I literally, at the end of March, I think I was looking at a couple $100 left in my account, which is the first time I've ever said that, I think, in a couple years. Like, it blew my mind, really. And now I've kind of built it back up to a few $1,000. So I'm pretty comfortable in this situation, just to stay cautious, right? I don't want to, you don't want to run into those issues, man. I think the worst thing an investor can ever go through is selling a stock because they don't have enough money to pay their bills. I honestly think that would probably be one of my biggest fears as an investor. So I don't know if you have anything else you want to touch on. I think we'll just stick around for a little bit longer here, guys. We're going on about 42 minutes. I didn't even know we'd be going for this long, but it's always fun keeping up with the conversations. If you guys have any last minute questions you want to throw in, feel free. And thanks a lot to you guys that have already gone out and subscribed to the new channel. I'm really hoping we can grow that into something awesome if you guys enjoy these streams. So thanks a lot. The link's back up there if you guys want to subscribe. I'm going to be mentioning it more as things go forward. But yeah, if any other questions, guys, do you want to touch base on any of that, Matt? Because you're not cash flow stricken yet, but your job might be at risk. You never know. With the way
100%. Yeah, no, 100%. I mean, that's something that I look at as well. I mean, as much as I would love to go and, let's say, continue to invest heavily right now into the portfolio, that's something that scares the crap out of me, because I mean, people have gotten severance packages with the company I work for, in the past when things happened in 2015, 2016, and unfortunately people had to be furloughed or laid off, but who knows if that's going to be the case this time around. So I mean, everything can be different, right? And so I need to make sure I have that cash cushion, and you and I have talked about it. I think I have a decent enough amount of cash flow where in the short term, I feel like I would be okay, but would it be sufficient for long term, and being able to kind of,
depends on how you want to live. You can always
What's
get a
that?
car. You can always get a cardboard box at the end of the road. I mean, that's cheap living.
Well, I mean, that's what happened when I invested in Cardone Capital, right? I mean, I had to sell everything, and like everybody else thought I was living in a cardboard box. So
Thanks for throwing us in some questions here as well, guys. I'll touch base on a couple of these and I'll let Matt throw in his last final comments here. I'm going to touch base on the RY. I'll quickly touch base on the Canadian banks. We'll touch base on basically dividend versus growth. And then there's not much more I see in here. So I'll touch base with those first. Canadian banks are the better banks, in my opinion. If we're comparing them to the US banks, I would still rather choose the Canadian banks. Though at these valuations with things like Bank of America, I would be lined up to start building those positions if you don't have them already. But historically speaking, the Canadian banks typically survive situations like these a lot better. And I think that comes down to scale as well, because our banks aren't nearly the size as the banks are in the US. And actually, the Canadian economy is growing much faster. Because our population is only something like 40 something million, I think, or just around that $40 million or 40 million. I said dollar at the end of that. 40 million people in the country, and it's expanding. If you compare Toronto right now to every other major city in the US, whether it's New York, you could even go out of the country. I think they were comparing it to places like New Zealand, and you'll see that like the major cities, Toronto is one of the fastest growing ones right now. And that does nothing but better for the banks, because the banks are kind of a cyclical business based off, how many people are, living in that country, how many people are having access to the variety of banks and what ones are going to your bank. So, I mean, I don't think we have as many banks as they do in the US either. I mean, we only have quite a small few, which is Royal Bank, Bank of Nova Scotia, Canadian Imperial Bank, Toronto Dominion Bank. And then we have kind of these subpar sector banks like your Western Unions and your, I think we have a new one here called Tangerine. So, I mean, I don't know. I think the Canadian banks, if you're buying them, you're not going to do wrong, especially at these levels, or the US banks. Don't get me wrong. Diversify either way. Now, on the growth versus dividend side of things, as Matt knows my opinion, we just had a very lengthy discussion about this. If you're looking for dividends or growth, I recommend 70% dividend, 30% straight growth. And you can even use that 30% straight growth as dividend growth. Find companies that don't pay high dividend yields today, like your Johnson and Johnsons of the world, and focus on holding them long term for dividend growth. But if I'm looking at my portfolio, I'm always 30-70. I don't know. What do you want to touch base on that real quick, Matt?
It goes back to what we talked about. Kyle and I had a lengthy conversation before we went live. And it goes back a lot to what your objectives are. I mean, if you're looking at someone like myself and yourself that are potentially in the boat where, you might need that cash flow in the short term, you might be investing completely differently than, and by the way, that Canada Dry, is that the lime version or the lemonade version?
Just a regular.
Damn. Okay. I was gonna say
for companies, by the way, this company's doing just fine, other than they might not be selling to the hotels. That's what you got to keep remembering about drink companies. Who makes Canada Dry? That's a good question.
But I mean, it really depends. I mean, if you're looking for the cash flow in say 30-40 years, I mean, I would agree more with what Kyle is doing. But I mean, if you look for cash flow today, you're going to completely organize your portfolio very differently. And so I think a lot of people, and I feel like I'm a broken record. I hate to kind of bug the crap out of people saying the same thing. But I think a lot of people always just look for what company should I invest in, and maybe they have a strategy behind that, and maybe they don't. But if you don't, I suggest you kind of sit down and understand what your objective is, what your time horizon is, what your risk tolerance is, because all those things pertain into what kind of companies you're going to be investing in for the long term.
Yeah, I guess that's a very good point. It really comes down to your own circumstances. But I don't want to go much beyond that. But maybe what we'll finish up with here is stocks that you're most interested in, and maybe I'll kick this off because I've been having such a hard time struggling between buying those good, solid foundational stocks like your Cloroxes of the world and your more deep value discount stocks, which I have set up on a drip, like your Canadian banks. But if I can throw up some new stocks that are my favorites that I haven't bought yet, that I've been analyzing way too much, and sooner or later I'll pull the plug once I get some more capital coming in. But I definitely want to touch base on Scott's Miracle Grow, which, oh my God, you got to check out Scott's Miracle Grow. Shopify never dipped, so I never bought it. Never dipped, guys. And I'm sure if you on the Canadian side of the border, you would have saw Shopify go over $1,000 a share today and over $100 billion market cap. I think making it in the top 2 largest companies currently in Canada, pushing for the #1 spot. So we got Scott's Miracle Grow, because that also has the marijuana benefit to it. And then we got Shopify tearing it up. And then stocks that aren't doing it nearly as well, but I would love to average into for the long-term holds, are things like Waste Management, which didn't have the most robust earnings, but at the same time, for those long-term stability, like your Johnson & Johnsons of the world, it's definitely been on my radar. Uncle Dave. I love the way we've kind of been taking side note, if you ever watch Grant Cardone critically, he calls his buddy Captain Ryan, and he also calls, we always call him Uncle, he always uses that term, right? Uncle Cardone there, Uncle whoever he's talking about. I think it's funny how we started picking up his slang, because you keep calling, every time you say Uncle Dave or you say Captain Ryan, the first thing my mind goes to is Grant Cardone. I think it's kind of funny how we've adopted his term.
I call people professor at work, so nicknames are a thing of mine. So
yeah. So yeah, what stocks aside from the ones in your portfolio are you kind of taking a peek at? What are your hidden door stocks?
Hidden door, I wouldn't say. I don't know. I picked up 100 shares of Wells Fargo today. I don't know if that's a good idea or a bad idea. I just looked at the book value, and I mean, I think they have like 1.9 trillion dollars worth of assets, and then they have about 1.7 trillion dollars worth of liabilities, and so they're left with about like 183 billion dollars worth of shareholder equity, but the company's only worth like 103 billion dollars when you look at the stock price. And so I'm like, 55% of book, I mean, that's pretty crazy. I don't think
they need to bottom out.
45% of the loans that are on the books well, maybe that's not a good way to put it, but I don't think 45% of the equity is going to disappear overnight. I mean, it very well could, but
they're my problem I have with them, because I bought them as well at way too high of a price looking in retrospect here, but I only have about $1,000 worth of it, give or take, and I want to average in like you have as well. But the question I have right now, and the thing that bothers me most about it, is waiting for the balance sheet to level off, because that last earnings report was pretty rough, and it would be nice to see not the stock. I don't care what the stock price is doing. I just really want to see the balance sheet start finding a new baseline where they're not bleeding capital anymore. Because I mean, after they went through that scandal with the opening multiple accounts, they got led to a fine, whatever that was. They lost clients. I mean, I thought that was going to be the turnaround story after that first dip. I'm like, okay, this is going to be the blunt of it, and then from here on in, it should start leveling. But then this pandemic hit. Now all of a sudden, we're seeing just terrible earnings. In retrospect to their balance, to the stock price, I think it's really fair value, but that comes back to the same point of where the bottom is on the cash flows, right?
Yeah, I mean, comparing it to the other bank stocks, I was looking at the Bank of America's of the world, the JP Morgan's of the world, and I forget what the third one that I evaluated was. US Bank was another. They're all at about 75% to 100% book value. And so comparing it to all the others, I would say that Wells Fargo at the moment is probably a little bit poorer of an investment than, say, those companies if you were to look at them on a like for like. But the discount for Wells Fargo comparatively to, let's say, a Bank of America, which was trading at 75% book to value, I think, or maybe it was even more. But that just means, in my opinion, that it's trading at like a 30-40% discount to some of those organizations on a like for like basis. And I don't think that that's the case. I think if you were to look at it, I don't think that Wells Fargo is in any worse position than, say, any other bank in America. Granted, yes, they did have their recent scandals, but that doesn't mean that their assets are in any worse shape than, say, JP Morgan's or US Bank. So that's just my opinion. I don't know if that's true or if that's a fallacy, but that was one. And then QQQ, you and I talked about that one as well. I'm historically pretty low in terms of technology investments. So
got to scale those up, man. You're missing out.
Yeah, I know. Yeah. So for the long term, I think that's where I'm going to start investing my M1 Finance money. What is it? $250 in the first, and then $250 in the middle of every month. So
I find it so annoying because it's so frustrating. It must be so frustrating to be an investor to go so far out of your way, especially if you're a new investor, to maybe find something like a Wells Fargo or one of these REITs, and you're analyzing and analyzing and analyzing, listening to conference call after conference call. You're like, this is great. I'm going to keep throwing money at it, but the stock keeps going down, and you watch your portfolio bleed, and all you had to do was buy Apple, Microsoft, Facebook, or Google or Amazon. I think it's so, it must be for me anyways, because when I look at it every single time, I'm like, well, why didn't I just buy these? I'm like, I like having them as 30% of my portfolio, but at the same time, it's just like, it seems like if you want to get rich today, you might as well just stick with the big guys, and you don't have to make any severe bets. You don't have to overeducate yourself on the companies, because you got to keep in mind, when you're buying value stocks, you're buying stocks like me and Matt are buying here, like there's risk. And the more risk there is, the more logical and in depth you need to be with the information you're reading and deep diving into. Whereas with something like an Apple or Microsoft or Facebook, like you could throw money at it, you know how it operates. I mean, you probably don't even need to look at the balance sheet, and you're going to do just fine. I always just find that interesting, and it'd be neat to see you start buying into them too. You already got some. I mean, you got Google in there. My girlfriend has a goal that I think I mentioned to you, that she wants to be able to buy one Amazon share, which I think would be a really good goal to have today, because I mean those shares are insanely expensive, especially in Canada, because we have to do the conversion. So I mean, if it's what, $2,300, it's almost 3,000 CAD for one share. But I think it's a great stock. It's going to be another one of those stocks that 10 years from now could, be a $2 trillion company for all we know. And that's another big debate that I have too, is scale. Scale stops making sense all of a sudden, because companies like Apple shouldn't double that fast. Companies like, when they're trading at $1 trillion market cap, it's hard to keep visualizing that for you to double your money, you're going to have to put, they're going to have to come up with another $1 trillion in market cap. And I don't know how easy that is. Whereas,
well, it depends, Kyle. I mean, if you look at Apple, the earnings potential of Apple didn't double. It was a combination of the earnings growth as well as the multiple.
Share buybacks as well.
Yeah. So I think that has a good portion to be with it as well. Same with Microsoft. Microsoft went from trading at 15 times earnings in 2016 to 2018 to now I think that's closer to 28 to 30 times earnings.
That's actually a good point. You're right. The spec play could take off, and it could do what Tesla does, and you could be at $1.5 trillion, and then all of a sudden you're just going to see the PE multiple go through the roof. But it's just it's really neat to see the shift in society, where these tech stocks that were considered these growth high risk stocks, like you were saying earlier, that like the PEs have drastically dropped on them. Like at one point, Apple's PE was absurd, wasn't it? Like even 10 years ago or something, wasn't it sitting at like 40 or 50s?
I don't remember.
It'd be neat to look at the historical record on the PE ratios, because now these stocks that were considered high risk that you should try and avoid are like the staples to society. And now they're the stocks you have to have in your portfolio. And all the ones we thought were staples, like your banks, like your REITs, are the ones that are in severe trouble right now. So it's an interesting shift nonetheless. But on that note, you got anything you want to just say bye, finish up? If you guys want to check out Matt Money, I mean, you know who he is, you know where his channel is.
I'm trying to think if there's anything else, man. I think that was a relatively good chat, but I think it would be good to talk a little bit about what we are hopefully planning on doing. I think some folks might have been in here when we were talking about potentially doing the future live streams and asking people questions beforehand, but I don't know if you want to touch on it again.
Yeah, I'll finish up with that. I'm actually just trying to re-grab the link again so I don't lose it here. Moving forward, guys, we want to start doing, for those of you that weren't here earlier on, we want to start doing weekly live streams on Sundays, and we want to be able to invite all of our dividend investing buddies, like Captain Ryan from the Independent channel, who's got a ton of subscribers. And we want to get Matt, obviously, and we just want to get our community all together in a place where we can sit down on Sundays, and hopefully always one of us will be there to have a conversation with you guys over some drinks, Sunday drinks, whatever you want to do, just hanging out. And the problem is we want to kind of make a communal YouTube channel where everybody can go. And unfortunately, sorry, I just got sidetracked because I'm trying to share the link and it says YouTube rejected your comment. This is fairly common when sharing links. You need to share the link in another way. That's not fair. I just did it already. I'll go back up and try it again. Sorry for the segue, guys. I'm trying to share with you the link of our communal YouTube channel. It's going to be like our Sunday church, for investors. So if you guys want to come and hang out, I'm going to start posting videos there of me and Matt and our private conversations we have off the streams. But eventually we need to get 1,000 subscribers so we can actually start doing our communal live streams. So what I'm going to do is throw this up. Not that that helps at all, because there's no way anybody's going to copy that. How do I want to copy this? Put user in time. I can put my own user in timeout. How does that make sense? Yeah, anyways, the YouTube channel is called Passive Income for Dummies or Passive Income Educator. It's only got a few subscribers on it right now, but if you guys want to go and support the channel, we need to grow it to 1,000 subs before we can make it the communal live stream. I'm going to try and share the link one more time. It really bothers me that it's my live stream, it's my link, and it won't let me share it. It just cuts it off. And so I don't know if I can find another way to get my, okay, it shared this time apparently. Can you see it come up in there, Matt?
Yep.
Did you see it share? Yeah. So click that link. Go ahead and subscribe, guys. Even if you don't want to watch our Sunday church get-togethers, it'd really help out just to get us to that level where we can start live streaming. You'll probably hear me talk about a lot over the next week, along with I'll probably hop on Ryan's live stream on Friday, or maybe even maybe while we're floating around, we'll hop on J-Mac's live stream tonight and try and throw it in there and give him the idea as well, and see if we can't keep growing a channel we're not really utilizing too much yet. But yeah, other than that, we've been going for a solid hour. So thanks for stopping in, guys. Thanks for subbing. I'm probably going to delete this live stream just because it was a last minute thing. It was really choppy in the beginning. So this is kind of a little private tutor for you guys, but stay cool, stay awesome, and we'll catch you all on the flip side.
Cheers.